Today, we're going to address the issue of indexed universal life insurance, and we're specifically going to address a long-standing criticism that people have brought against the product, the criticism that it's simply too complicated. There's lots of moving parts, and perhaps it's just not worth trying to wade through all of those things because the risk of screwing it up is far too high, given all of that complexity. I want to start by noting that despite its reputation for being a boring and old school industry, the life insurance industry itself is actually quite innovative. It has, throughout the course of the past few decades, brought about several magnificent changes in the life insurance world that have affected all product types. This includes whole life insurance, term insurance, and the introduction of universal life insurance, which is just somewhere in the neighborhood of 40 years old at this point. And all of these changes that have been brought about have absolutely improved the functionality and the benefits that people get from their life insurance product. We could talk about things like the introduction of an elective paid-up additions rider with whole life insurance, or term blending that has allowed people to purchase whole life insurance at a lower initial cost. It's also allowed us to manipulate whole life products to vastly improve the cash accumulation feature of it. Term life insurance has certainly evolved to be more budget friendly, as well as add numerous benefits that credit people for the premiums that they pay in the event they want to change their term policy into something permanent. And universal life insurance itself came about as a way to harness the incredible tax benefits that one enjoys with the cash buildup inside a life insurance policy, while giving them greater access to the development of that cash. If you were born after 1970, all of these innovations have taken place inside your lifetime. So the industry does not necessarily sit around completely oblivious to the fact that times change and people demand innovation. And indexed universal life insurance stands out as a product that seems to be the most keen to the demands of a changing economic environment and the changes that must come along with financial products to satisfy a public looking to consume these style of products. Fundamentally speaking, indexed universal life insurance seeks to provide a higher rate of return of the cash buildup of a life insurance product, while also minimizing the risk of loss that a lot of people want to avoid, especially people who seek out conservative style investment and savings plans. When it was originally introduced, the product functioned very simply. Your cash value would earn an interest payment that was tied to the movement in the S&P 500 up to a certain limit. Now, those with at least an intermediate understanding of options trading likely understood very quickly what the life insurance industry was doing when it came to indexed universal life insurance and how it was creating its interest payments tied to something like the S&P 500. It's a simple options collar strategy. It sets a minimum and a maximum result each and every single year. The strategy, the trade strategy, I should say, is nothing new. But when it comes to introducing that as a feature within a life insurance contract, that was quite innovative at the time. And all on its own, it unlocked new opportunity, also providing new safety that the industry had never been able to deliver to its potential customer. And while the product has been wildly successful at bringing in new premium dollars to that category in particular, the industry doesn't appear to be interested in sitting back and just allowing the success of the most simplistic introduction of indexed universal life insurance rule the day. Since its inception, we've seen a vast amount of innovation, all in an effort to bring ever-increasing potential benefits while also trying to minimize probably the most undesirable trait of indexed products, which is a year where you do not receive an interest payment. If the index is down, index products simply don't pay an interest rate, so you stay at zero. And since it's life insurance and there are expenses to life insurance products, you generally rock back a little bit in terms of cash value because those expenses are going to be deducted from cash. Since the introduction of indexed universal life insurance following just a simple S&P 500 indexing option, we have seen numerous index options introduced that span the globe when it comes to available asset classes. We have foreign indices. We have the bond market. All of this is done in an effort to diversify exposure in an attempt to minimize the number of years when zero is the resulting interest rate. But it also happens to unlock opportunities when various asset classes shine and others lose their luster. We've also seen the introduction of volatility adjusted indices. These index options tactically change allocations within the index composition to try and minimize the risk of volatile stock markets by shifting into something safe like bonds or cash and benefiting from those asset classes in the way that they typically unfold when, at least in the US economy, we try to combat the impacts of a volatile market, which is generally brought on by recessionary times. So when stocks fall, traditionally bonds rise, and volatility adjusted indices have a tendency to perform well in these moments. Take, for example, this chart right here, which shows us one such volatility adjusted index. And notice the year 2008, a year when the S&P 500 was down nearly 40%. This index was instead up over 5.75%, which is a result many people would have killed for in that year. The sophistication doesn't just stop there, though. There are some companies now introducing features that allow us to essentially call the interest rate early if we want. We can lock it in mid-year versus waiting till the end of the policy year and hoping that our good results up to this point persist until we get to the end of our policy year. This further allows us to minimize losses or lock in gains that are sufficient for the individual. And from the conversations that I've been having with various insurance companies, I can tell you they are keen on building additional features and additional index options that will do their very best to deliver more rate of return to policyholders while also attempting to minimize bad years. Additionally, it's worth noting that all other product categories inside the life insurance industry as it relates to cash accumulation have, in some cases, attempted to incorporate an indexing feature. We have seen the introduction of an indexing dividend scale with certain whole life products. We've also seen several companies roll out an indexing account inside variable universal life insurance. It's obvious that this feature is one that many consumers of life insurance products absolutely desire. And why not? It has a lot of great potential and a lot of great benefit. A higher than average rate of return on a fixed savings plan, while at the same time ensuring that at the very worst, zero interest is your bad year. Because even in years when the index is down, you do not participate in that decline. You instead get no interest. And there's also a win-win component to this. So from the insurance company's perspective, the investment strategy that creates most indexing products is one that doesn't necessarily demand a whole lot of operational profitability from the insurance company itself to deliver that benefit to its policyholders, and certainly doesn't require additional operational performance to carry on future performance of the indexed product. Let's use an example by drawing a parallel with whole life insurance to explain exactly what I'm talking about. When it comes to whole life insurance products, the key driver of cash value development inside that product is operational performance, profitability at the insurance company. That's where dividends come from. So in order for a whole life product to continue to prosper on the behalf of the policyholder, the insurance company must continue to grow its profitability year over year. Some of that profitability will come from investment performance, and that is the easiest way to grow profitability performance at the insurance company, and it is the one that insurers have used or leaned on the most heavily over the past many decades. But the profitability of being an insurance company also plays a role. And while insurance companies can grow the dividend through operational profitability as an insurance company, for some, this has proven to be more a liability as certain lines of business have proven less profitable to them. This is the very reason certain quiet companies from the upper Midwest used to criticize the hell out of P&C companies that were in the whole life business because it was very hard for them to manage their risk in the home and auto business and not have that become a drain on the dividend payable to their whole life insurance policyholders. And there's a lot of empirical evidence that bears that criticism out. It is certainly the case that companies involved heavily in the property casualty game have struggled to maintain profitability that could feed into the dividend for whole life policies, and it's that reason that very few of them continue to do it. But being engaged in the home and auto insurance industry is not the only case of liability dragging down dividend performance. We've seen other life insurance companies struggle with lines of business that have absolutely impacted negatively their whole life policyholders. There's one in particular from Ohio that stands out. That's not to say that whole life insurance is bad. There are many really great mutual life insurance companies that are engaged in the whole life business, and they will continue to be excellent at it. But it is fundamentally my opinion that indexed universal life insurance will continue to be the more innovative product with the higher potential for rate of return, at least until one of these companies figures out a way to master the process of introducing indexing features to whole life insurance, which has happened in some respects, but to date has not been nearly as impressive as we've seen on the indexed universal life insurance side. So conversely, with indexed universal life insurance, the function that feeds the cash accumulation is simply the execution of the trade strategy, the options collar that I mentioned earlier. This does require some degree of sophistication at the trade desk of the insurance company, and there's definitely a diversity in sophistication among insurers and their investment trade desk prowess. And we've absolutely seen companies with noteworthy capabilities from a trading perspective pull a bit ahead of those that were a little bit less sophisticated in that department. And I think we'll continue to see a lot of innovation unfold across the industry in general, but there is a good chance that those that are already ahead are going to pull further ahead as they continue to innovate on their product lines. But the important thing to understand is that indexed products, indexed universal life, and indexed annuities as well, bring a substantial amount of sophistication to the table that is, tactically speaking, incredibly beneficial to you as a potential policyholder. Trying to build wealth and net worth through various instruments, life insurance and annuities could definitely be one of them. And the amount of sophistication that is being applied for your sake is something that would be incredibly difficult to replicate anywhere else with any other financial tool. So while it may seem complicated, if you really dive deep and you are intellectually honest about your pursuits and understanding these products, what you start to understand is that it's not complicated at all. It's just sophisticated, but it comes with a substantial amount of benefit because that sophistication brings a tactical advantage from growing wealth with a lower risk exposure. The number of things that indexed products bring to the table today is, frankly, mind-blowing when I think about the beginning of my career nearly 20 years ago and what was available back then. I continue to stand in awe at the innovation that has taken place with this product line. And I especially have remained very intrigued and impressed at the resiliency of this product in the most recent economic circumstances that have unfolded since 2020. And if you're looking for a way to truly diversify risk inside your own portfolio, it's time to give indexed insurance products a good hard look.